How to generate consistent monthly income from your RSUs with covered calls. Do you have restricted stock units sitting in your brokerage account? They're a valuable part of your compensation, but most people just let them sit there, waiting to sell them someday. What if I told you there's a way to turn those RSUs into a steady stream of monthly income? In this video, I'll break down exactly how covered calls work, walk you through a real-life example, and discuss the trade-offs, and help you decide whether this strategy makes sense for you and your RSUs. I'll use concrete numbers so you can see exactly how much you could potentially generate by incorporating covered calls into your investment strategy. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. When your RSUs vest, they're just like any other stock you own. At that point, you can hold them, sell them, or as we'll discuss today, use them to generate income through covered calls. To keep it simple, a call option is a contract that gives someone else the right, but not the obligation, to buy your stock at a set price, called the strike price, before the option expires. The buyer pays what's called a premium for this right. When you sell a call option on shares you already own, that's called a covered call. You're essentially giving someone else the right to buy your shares at a predetermined price in the future, and you collect the premium regardless of whether or not the option is exercised or not. This strategy is especially powerful for people with concentrated positions in their company's stock because it allows them to gradually reduce their exposure at prices that they're comfortable with, all while generating extra income along the way. So for a little options education, one options contract correlates to 100 shares of the underlying stock in that contract. So if you want to cover a 1,000 share position that you have in your company stock, you would need to sell 10 contracts. Let's walk through a simple example. Say your company stock is trading at $50 and you sell a 1-month call option with a strike price of $55 and a premium of $1. You own 1,000 shares, that's 10 contracts. $1 per share times 100 shares per contract times 10 contracts equals $1,000 in premium income up front. So there are two possible outcomes here. Number one, stock stays below $55 and the options will expire unexercised, in which case you keep your shares and the $1,000 you received for the premium. Number two, stock rises above $55 and the buyer exercises the option. You sell at $55, locking in $5 per share of gain plus the $1 premium for the total of $6,000 in profits. Now, let's take it a step further with a real-world example using Qualcomm to show you how this strategy can be put into action. Imagine a monthly approach where about 30 days before expiration, you sell covered calls with strike prices about 4 to 5% above the current market price. At the time of this recording, a call option with a $165 strike price expiring in 34 days has a premium of $2.15 per share. That's $215 per contract. If you hold 1,000 shares and sell 10 contracts, you'll immediately collect $2,150 from the sale. If the contracts are exercised, you'd sell at $165, locking in both the premium and the price appreciation for a total gain of roughly $9,300. If they expire worthless, let's say Qualcomm stock doesn't appreciate, you still keep the $2,150 and you'd be able to sell another round of contracts the following month. Assuming for the sake of simplicity that premiums stay consistent at around $215 for calls 4 to 5% above the current market price and expiring in roughly 30 days, you could theoretically generate about $25,800 in extra income per year from this strategy if calls never get exercised. Of course, some months your contracts will be exercised and you'll sell more shares. But that's why this works so well with RSUs. As new shares vest over time, you can continuously sell new contracts to maintain your target allocation while also generating income along the way. The strategy also provides a measure of downside protection. For example, if Qualcomm stock price drops from $158 to $155, your contracts would expire worthless, but you'd still keep the $2,150 premium. So instead of being down $3,000 in unrealized losses at that time, you'd only be down about $850. And you'd still be able to sell new contracts the following month if you decide to still hold the stock. Another attractive scenario is when stock rises but doesn't reach the strike price. If Qualcomm goes to $163, the $165 calls remain out of the money, meaning they won't be exercised. In this case, you'd keep the $2,150 premium, plus you'd have an unrealized gain on your position for a combined benefit of $7,150, while still holding the shares to sell contracts on again. It's important to understand, however, that covered calls aren't free money. They come with trade-offs. The main advantage is that covered calls give you predictable income and a little bit of potential downside cushion. The main downside, on the other hand, is that if the stock skyrockets, you've capped your upside potential. Going back to the Qualcomm example, if the stock suddenly jumps to $170 and you sold calls at $165, you won't participate in any gains above the strike price on the contracts that you sold. That's why it's crucial to set strike prices that you're comfortable selling at, rather than just chasing the highest premiums. There's also the tax side. When RSUs vest, you've already paid ordinary income tax on their value, generally. After that, any sale, whether from an option being exercised or you selling directly, triggers capital gains tax. Premiums from covered calls are typically taxed at short-term capital gains rates. And if the options are exercised, you're selling the underlying shares, which also means realizing capital gains and losing the benefit of tax-deferred unrealized growth. That's why it's important to consider how it could impact your tax strategy before placing any trades. If you're considering selling covered calls on your RSUs, start by confirming your brokerage account is approved for options trading. Then decide how many shares you want to cover. Remember, one contract represents 100 shares, and select a strike price you'd be comfortable selling at, along with an expiration date that fits within your plan. Most importantly, don't approach covered calls in isolation. This strategy works best when it's part of your comprehensive financial plan that accounts for your cash flow needs, tax situation, company trading restrictions, and long-term goals and risk tolerance. At Pacific Wealth Management, we specialize in integrating strategies like covered calls into our clients' broader financial plans, ensuring every decision helps maximize their investments while staying aligned with their long-term goals. Let's wrap this up with a few key takeaways. 1. Covered calls can turn your RSUs into a consistent stream of income while helping you maintain a balanced allocation to your company's stock. 2. They're most effective when you set a strike price you're truly comfortable selling at, instead of chasing the highest premium. 3. Premiums are generally taxed as short-term capital gains, so always consider the implications on your tax strategy before executing trades. 4. This strategy is most powerful when embedded into your broader financial plan, one that aligns with your goals, cash flow, tax situation, and risk tolerance. Ultimately, covered calls aren't a free lunch. They're a disciplined tool. Used wisely, they can help you make the most out of your RSUs, generate additional income, and reduce concentration risk. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com. Thanks.